Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, July 22nd, 2020. What we're going to do in this video is take a look at the market here. We'll focus on QQQ and the 5 market-leading FAANG stocks. That's Facebook, Apple, Amazon, Microsoft, and Alphabet, which is the G in there, GOOG and GOOGL. Those 5 stocks collectively have such a enormous market cap and weighting on the indexes, particularly QQQ, but also a heavy weighting in SPY. And so I'm doing this because the first of those 5 report this week. So we're going to have within the next couple weeks here all 5 FAANG stocks reporting, and that can most certainly, if anything, is going to have an impact on the market. Stop to put the brakes on this rally, or even extend it for that matter. It's going to be these 5 stocks. So let's take a look at the charts. So QQQ. We did have last week the bearish engulfing candles. That was actually Monday the 13th, and so far that candle has been almost matched. We didn't take out the top of it, but again, no follow through. We didn't have any follow through to confirm those sell signals I've talked about quite a bit. So we still need to take out both this blue uptrend line right here and the this price support, which is Tuesday's. That was last Tuesday's low, the day after the bearish engulfing candle. That should do the trick technically to spark a much larger pullback or correction there. So that's what we're looking at. No change there. I do want to point out we have for the first time in quite a while negative divergence on both the PPO. We had a really such a big drop down into the March lows that you had a lot of distortion here on the PPO, and what you need to do is either zoom in real tight or just expand it. Then you can see as I lift it up, you can see the divergence there. You can see the PPO making a lower high, the downward sloping line. Same with the RSI down here. The RSI shows a little bit better, and with prices making higher highs there. Back in February, leading up to the market's high in February before the big plunge, we did have divergence, but only on the RSI. So we have, for the first time, again, in quite some time, clear negative divergence on both that. But let's look at the individual stocks because that's what's going to matter here. Apple. Okay, going through these just in order of market cap, not in order as they report, but I've made notations on these charts. Hopefully you can make that out in the video. This line, there's a horizontal line here, and that's on July 30th. Keep in mind as I'm going through this, all of these FAANGs and a lot of big tech companies, they tend to report after the market closes. Banks usually report before the market opens, and so just keep in mind. So when you see the line here, you're going to trade that day. You're going to see Apple trading on July 30th, but earnings aren't going to come out after the close. So the follow-through candle is going to happen the following day, July 31st. I believe that's if it's not a weekend, I don't know what day that. Yeah, that falls on a Thursday, of course. So yeah, Friday, July 31st will be the first day we see. Now, Apple may or may not even make it there without breaking down. It's been walking up this trend line. This is the yellow trend line I'm referring to. That's the uptrend line I've been watching on Apple. Very similar to that trend line I showed you on the Qs. And Apple's dancing on it right now. But still, let me be very clear, no sell signals. However, we do have, and this is why I wanted to do the video, nearly identical technical posture. Again, we have that squished out PPO here. Let me do something here. Let me pause the video and see if I can clip that big drop off there, and that'll help. It'll help pick out the divergences for us. I started playing around with the settings trying to clip this off, changing the values, but taking too long, so I'm just going to go back to the video here and just point out you can see the divergences drawn. I mean, this is, as you guys know, a big part of my trading, looking for these divergences, bullish or bearish divergences. As pointed out, we did have positive divergences on QQQ and a lot of things, especially on the intraday charts. Here's a positive divergence on the RSI heading into the lows. So for the sake of this video, we're looking at the divergent highs here. And again, let's just compare to the last major top in Apple right here back in February before the bottom fell out. I'm sure there's many out there that'll say, oh, this is exclusively due to COVID. No, we had a couple things that happened. We had, again, almost nearly identical technical posture on all these FAANG stocks. So COVID or no COVID. Now, obviously, I think that certainly accelerated the drop, the amount of the drop. But you can see here, you had these clean up trend lines right there. You had negative divergence right here, building on the PPO, building on the RSI. You had overbought conditions. All of this heading into earnings. You can see up here I have the earnings dates for the last couple of earnings, and those tend to be turning points in a lot of stocks, particularly Apple, but a lot of these FAANG stocks, it tends to be inflection points. Now, inflection points could be after a downtrend, you have a positive earnings report, and that turns a corner. That's not what I'm showing here. We're only going back the last two earnings, and the next one's coming up on July 30th. So that's it. So we had earnings right there, and that was it. It didn't knock the stock down right away, but the stock topped. And it had this little trading range here. It failed to build on any of the gains after earnings, and extended the divergences to this point, and then the stock had that 30 whatever it was percent drop on Apple. It was, again, doesn't look like a lot because there's big price swings. 35% drop right there you're looking at, and then of course we all know what happened after that. So what I'm doing here is going off pure play technicals. Forget about fundamentals, forget about the momentum in the market. I'm looking at technicals, and that's the whole point of this video. And I've not given up on technical analysis. This has just been a lot of factors in this rally that's lifted so many stocks higher. Number one, first and foremost, Fed induced. I still view it as a bear market rally. There's many, in fact, the majority of stocks are still well off their previous highs from back in February. So it's only been a crowded trade, mostly, I should say, in technology and mainly these big FAANG stocks. Other factors that are well documented is you have a slew of people at home, either lost their jobs or working at home and have the time on their hands. So you've seen a huge surge in retail traders, day traders, speculators, people gaming the market. That's evidenced by a big surge in brokerage account openings. You have things that also play into this rally that, again, it's documented, such as all the professional and college sports being shut down. So you have a whole pool of gamblers out there in the U.S. A lot of people addicted to sports gambling, and you have some of the big online gambling companies. Or what is that one where the owner, he's been tweeting out since you don't have the betting going on. He's been tweeting out stock picks and gaming the market. So a lot of this has been retail crowd has been chasing up these stocks, and I think it's setting the stage for a potentially very big drop. Where before, for a while here, is looking for a correction, waves. We could get a very sharp drop. We may be looking at one of the best shorting ops since this one back here in earlier this year. All right, so leave it at that. Technical analysis here, divergent high, very clear divergence. You can see it on Apple. Same thing, overbought. We were overbought here, and that's the nature of divergence. You usually hit the overbought level. By the way, I've talked about this before. I like to view every individual stock, every sector, every commodity different when you look at what's considered overbought. The standard definition, most charting platforms are going to give you a line at 70, which is this red line here, and they're going to give you, and that means overbought, and you're going to give you a line at 30, which is oversold. Obviously, you can see Apple gets down to 30, especially in a bull market. That's a great time to step in, but in this case, you had positive divergence. And it's the same thing in reverse. Usually in a bull trend, you become very oversold, and that's not the top. The momentum starts to slow down, and that's what negative divergence is all about. This isn't magic. It's showing you that the momentum in a rally is waning when prices continue higher or continue to hold up at the same level, and the indicators, these momentum indicators, start to drop. That is showing you a change in the momentum of the trend, and it usually precedes trend changes. So that's it. Negative divergence. What are we missing now? Sell signal. Apple's starting to crack, but look, Microsoft or any of these five FAANGs can set the tone for the rest of the stocks before they even report, but it's unlikely. You're usually not going to see a stock make a very big move right in front of earnings. Again, who wants to take, whether you're a bull or a bear on Apple or any of these stocks, who wants to risk a big position right in front of earnings? I will say this, that I will be, am and will be going, mildly short into earnings not on the individual stocks. I prefer to play the NQs, the NASDAQ 100 E-minis, or even QQQ, because I think the charts are so compelling, and I've said this many times in the past. Earnings themselves, in a vacuum, when a company is scheduled to report earnings, It is in a vacuum, it's a crapshoot as to whether that stock is going to go up or down after earnings. Some stocks have a history of big gaps. You look at Netflix and other ones, for example, you can almost bet your bottom dollar you're going to see a gap of 5, maybe even 10% or more on those. And then other stocks they don't gap as much, at least not historically, because a company does a better job of managing expectations. But the point is, what I was trying to make is that if a stock is clearly, if the technicals are clearly bullish or clearly bearish heading into earnings, it has been my experience that much more often than not, in other words, it's no longer a 50-50 crapshoot as to whether the next trend or the next big move after earnings will be up or down. The charts will usually indicate which way the stock is going to go after that. Usually is not always, it's far from always, but it's well above 50%. So I'm trading to calculated risk, that's what it's all about. And so collectively, that's the whole point of this video, all of these stocks have almost identical postures. And that is because they're all top weighted in, components. They move more so by inflows and outflows to the NASDAQ 100. That's largely what's driving this. And of course, there are a lot of individual traders and hedge funds and mutual funds that are buying these as well, but a lot of it is due to indexing. And so when that trade changes, when money starts coming out of QQQ, out of the NQs and all that, these stocks get sold more so than the smaller weighted stocks within there. Because remember, QQQ, if it has a lot of redemptions, or a mutual fund, they have to sell what they own to meet those redemptions. And if they own 10% of the holding is Apple, they're gonna sell more Apple shares than they're gonna sell anything else again. And then the Qs will do it proportionally no matter what. If the inflows and outflows out of an index tracking ETF they're going to take the money out of the stocks proportionally. And these are the ones that have the highest weighting. So there's my outlook for Apple. Oh, I want to give you targets too, because things tend to move fast. If we get sell signals, first target here about 354.48, and still a big level that since back here I said unless we need 2 sell signals here to really start the party going to the downside for Apple in the market, and that's the yellow uptrend line. Now we've walked quite a bit away from this 327 level. That was the other level I had. It was a big level. That was the peak back in February, or actually January, late January to late February. We tried, tested for a while, and finally broke out. So this whole thing is a breakout to new all-time highs right here in Apple. And Apple never really came and back tested that. After the breakout, close to it, but that's not a back test. I would say that if and when we get a correction, that's the level that a lot of traders are going to be focused on. That's where the buyers will most likely step in if and when Apple gets there. And I think that's a very logical target. And we can also, by that, assume if that is hit, you're talking about a 15% drop. Therefore, the market should, give or take, also drop about 15% because it's going to move in line with Apple. Microsoft, next one up. All right, Microsoft, we had recently right here, bearish engulfing candle, negative divergence, divergent high. That's something we didn't even have with Microsoft back at the February highs. It didn't even have negative divergence. We put in a high right here, and you can see the crosshairs, no divergence on the PPO or the RSI, yet it still rolled over. And again, a lot of that's forced selling, panic selling, everything that went on. But I just wanted to say there was a trend line break, and you can see it there. So there was a sell signal in that. You had a trend line break right there and a back test offering you an objective short entry or another exit if you were long and you didn't get out on the trend line break, or you didn't get a short here. There was your last chance before the big drop into the lows. So there was a sell signal by that metric. Now what we're looking at, just like this was the trend line back then that did the trick, this is the one right now I think will do the trick. So that's our level. We also have right about where that trend line comes in, 201.35 support. And so that's what Microsoft needs to take out. Now, they are reporting tonight. This is the first thing to kick it off, July 22nd after the market closes. So let's see where we go from there. I'm going to throw it out there now. I've said it a bunch lately. We're heading into peak earnings right now. And so the odds that you're going to have over the next couple weeks that you're going to have a decent sized gap in the market, an opening gap that could be up or down, is going to increase because of these big market moving stocks. If AutoZone has a big 5-10% gap up or down, it's not going to move the market. If Microsoft gaps up or down 10%, you can bet your bottom dollar it's going to move the market quite a bit. It's going to move the tech sector, and it's going to move the entire market, including the S&P 500. So, point is, if you're risk adverse, probably not a good time to be heavy short or heavy long. Sit back and see how the earnings start to play out. And if you are an aggressive trader, somewhat, there's, I think, nothing wrong with taking, starter position, depending on how you think things are going to go. If you think there's more upside, if you think these divergences won't play out like they have so many times in the past, like they had here for a 19% correction. We had a divergent high there, and it played out for a correction, but a correction in time, more so in price. That was several months right there. You can see down below. And so again, I talk about it often. Divergences can play out, or corrections can play out and manifest in either time and or price, or a combination of both. This was mostly a combination, or mostly a correction in price, correction in time, correction in price. And again, it's clearly, to me, the technical posture at this point in time is bearish, but no sell signals yet. And we did have that bearish engulfing the other day, but not really confirmed, because the following day we put in a green candle, then we put in a red candle, but we were up above the bottom of that bearish engulfing. Had a couple red candles there, but we hit support again. So this is not what you want to see. So these really haven't been confirmed, at least not the bearish engulfing on Microsoft. All right, next one up would be Amazon. And again, Microsoft tonight. Amazon is reporting on July 30th after the bell, and you can see, so we've got a little bit of time left to go. Here we had a bearish engulfing candlestick plus a divergent high right there. We did have some confirming candles, but what's happened is the rest of the fangs haven't broken down or haven't given us any sell signals, and we had that big pop on Monday in Amazon that's kind of, I'll say this, the bearish engulfing is still intact. Here's the high point of it. We only came about to the midpoint, maybe about 2/3 of the way up, which is about the upper end. And so there's still a possibility this may play out to be a topping or reversal stick. It wasn't just that. We also had a break below the trend line here, the minor uptrend line as well. And when I look at the bigger picture, and that's what I'm doing this video for, I see same thing that I've seen in the previous corrections. This was a divergent high back here. And that led to that drop, which again doesn't look like much because of the move afterwards. But if I measure it out, I'm grabbing the highs there to the lows. That was a 26% drop right there. So the last time we had negative, and it was a little small divergent high. We have very big divergence at this point in time. Back here, we were overbought, and DT is double top and divergent high. So a lot of things going on. By double top, I had to scroll back here, showing you we had a failure here, and yep, you got it, divergent high. I had these targets at the time, and that drop was for grabbing a little bit above there, so I'm going to stop a little below the bottom. That was about a 34% drop. Boom, 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 boom. Hit all my 3 targets right there like clockwork, and reversed at the bottom. A divergent high there, 16% drop, divergent high, 14% drop. You get the picture. So these things work more often than not. So again, it's all about playing the odds. We're going into earnings. We're very overbought. Last time we were this overbought on Amazon was right about here. So here's our overbought readings. We were overbought here. We were overbought here. And you can see what happens. So again, I look at these charts, and to me the risk reward is about to be long or to go long at this point more so, because if you're long and you want to trail a stop up and let it run as long as this craziness goes on, so be it. It's worked for quite a while. But to go long at this point, enter a new long position, is to me, as you can see, I'm making a case that stock should be a short here and probably going to drop. So obviously I can't make a case to take a new long position here. And again, everything's a crapshoot because earnings can go either way. Obviously, the whole COVID thing played very well into Amazon's business model. We all know that. Last time I mentioned the stock during the whole COVID crisis was right here at 616. I said that looks like an objective long area to go long Amazon. Obviously, in hindsight, kicking myself for not buying as many shares as I could and throwing away the key, but it's been a nice run since that pullback. That was a very well-defined support level, 616. I've had it on the chart here for a while, and that was proved to be a great buying op. And I liked it because of what I said at the time. Fundamentally, this, of all the FAANG stocks, had the best. Again, COVID played into its business model better than all the rest. And I believe, if I'm not mistaken, I believe it was the strongest performer since. The stock has doubled since then, up 107% since that low. But hey, okay, how much of that 107% rally, in fact, that is way above where it was back here at the previous peak, how much of that's been priced into the stock? I'm going to say all of the benefits that it had from COVID, and then a lot more. So, basically everything in the market, whether you have corrections or rallies, stocks tend to get ahead of themselves, and the pendulum tends to swing too far in either direction, and then you get those mean reversions. You just take a long-term chart, and you talk about a mean reversion. You look at a long-term trend line on just about any stock or the market, and every now and then the stock wants to come back and visit those long-term trend lines. And so that's a likely target for Amazon going forward. Again, would be this long-term trend line, and that's quite a ways down before we get to that level. But you can see near term, here's the levels I'm looking at, about 2786.60 right there. It's price support plus this yellow uptrend line. So that's your first level, and they come in close together. So hard to say when it's going to get there. And again, probably not going to do much before earnings, but it could, because you have other FAANGs reporting before then that may start to set the tone for the market in general. So hard to say what happens over the next week or so, but I think it's safe to say within the next 2 weeks, once their earnings are out of the way here on Amazon, we'll have probably come back all the way down here to this level. It's a big level. 2470. It's the one I've been watching for a long time. Those yellow lines were the levels I said had to break to really open the door for a deeper correction. And Amazon's remained above both of them. So the trend's been healthy and it's intact. Really, again, other than the recent bearish engulfing and that trend line break, that's the first time we've had a sell signal, a half decent sell signal on Amazon. It would have been a lot better had we had other sell signals on the FAANGs, but we didn't. So it's kind of a questionable signal. So there it is. There's your targets. Preferred swing target. How much would Amazon have to drop to get there? That would be a drop of about 19. Did I have the line there? Yeah. Oh, about 20%. So we had Apple dropping about 15%, Amazon about 20, and depending on how things look at the time, what's going on in the economy, they don't seem to care about COVID. But the thing about that is, the news will change on a dime. Sentiment changes on a dime. You get a pullback. You have these FAANGs start to break these levels. All of a sudden, all these rise in cases in COVID will matter. And right now they're being shrugged off. Nothing seems to want to stop the rally, but all of a sudden they'll start to focus and they'll blame the drop most likely on the increase in cases or whatever it is. The media will always slap on a headline. That's one thing that is the one constant I've learned over the years. No matter how ridiculous the excuse or the reasoning behind a rally or a correction, I'll never hear them say, "Oh, well, the Amazon broke trendline support, key support level." They don't talk about that, not on at least on the mainstream media. Sometimes the financial media, CNBC and the lights might mention, bring on a technical analyst, but that's it. So those are levels to watch there. A couple more, and we'll wrap this up. Alphabet. Same kind of thing. I don't have it here. Let me put up one more annotation here. Divergent high, divergent high, divergent high. You can see it's kind of wash, rinse, repeat stuff. And these are the big corrections. It's just how this stock trades. Look for these divergent lows, they're bullish. Then you look for a divergent high like we had right here at this point, bearish. Then you look for positive divergence. If you get it, you don't always get it, but when you do, great. There's your objective long entry. Also at support, there's a big support level right here on Alphabet. And this is swing trading. Look for the divergent high, and of course in the sell signals that follow, correction. No divergent low there, but we were oversold. There's another common theme. Look at all these oversold readings that usually come in place with divergence. And that's it. So here are your buying ops when you look at these indicators. The divergence down here, I'm starting to make a mess of things. Positive divergence at the lows and or overbought conditions. Boom, boom, boom. And that's it. There's your objective long entries that all coincide, each and every one with overbought conditions, most with positive divergence. And here are your tops. Negative divergence, divergent high, overbought conditions, divergent high, and divergent high. So I struggle to see why this time will be any different. The one thing I have to say, and I always say it, is not only are divergences not sell signals, they're just an indication a trend reversal is likely. You need to throw in a good sell signal to confirm and give you a trigger. And divergences can be, as long as you don't have those sell signals or the correction, they can be burned through. So while we have, this is what I call potential divergence, not confirmed. It becomes confirmed when we get a bearish crossover on the PPO. That means this orange line crosses down soon below the white line, and that effectively puts in another peak, a lower peak over the previous peak. That's what gives me what I like to call confirmed divergence when they cross down. Otherwise, it's a momentum indicator, and if the momentum is up and it continues up, then we can take out that previous high and we've taken out the divergence. So that's it. And from a price perspective, we really had a sell signal back here on Alphabet already, and I'm referring to the impulsive breakdown below the this trend line off the lows, and we've been back testing. And I've talked about that often. Sometimes you break down on a stock, you never look back. I mean, nothing falls straight forever. And then sometimes you break down and you back test. So this is just our second back test right there. And the divergences have only extended from that point. And then last but not least, you have Facebook. Again, it's a common theme. All 5 FAANG stocks all have divergence at this point in time. We had on a lot, but not all, back before at the in the highs. In fact, Facebook peaked back in January, and you can see, as so often is the case, I've told you, I've tracked these stocks for years. Quite often, earnings are an inflection point. There's January 29th. There's the all-time, up to that point, all-time high in Facebook, and it popped. No, that was the next day. If the earnings was, I had the line on the reporting date. So they, everybody was bullish in the market, keeping the stock, rallying it that day, the day that they reported to all-time highs, right up to the previous high, but a hair above it. And then you can see they must have disappointed, whatever it was, even if they beat expectations. That's what I want to talk about as well. I know I'm kind of all over the place here, but it doesn't matter whether a company beats or misses. It doesn't matter what their guidance is. What matters most is the market's reaction. And also to that, to take that one step further, try not to take too much of what happens immediately in the after-hour session. There's always, quite often, knee-jerk reactions. And the knee-jerk reaction, whether it's a big move up or down, sometimes is, but quite often is not the move that sticks. So you want to see what happens the following day, maybe even the following next couple days, once all the players step onto the field. Because big institutions, hedge funds, as liquid as some of these stocks are, the after-hour session doesn't have the liquidity. And usually the big funds will, if they decide, hey, I don't like what Amazon or Facebook said, they're going to start selling out, during market hours. And they're also going to, take time to read through, cull through the financial reports and all the data and all that. So that's it. So, take it with a little grain of salt what happens at night, even the next day, and then kind of see where we go from there. So that's it. We have negative divergence and big clear divergence on Facebook. I mean, these aren't little correction type divergences right here. This is more like trend change stuff. That has the potential to trigger a trend change. So what happens first, all major trend change start with either a minor correction or a rally, whether it's on the lows, and then they can morph into something else. So what Facebook needs to do, first and foremost, you have support here about 233.44 that needs to go. If that goes, bearish case gets the check mark. Next level, and a big level, even bigger, is about 222.78. We'll call it 223, whatever you want. That needs to then go, because that you can see is pretty good support here. It was that previous all-time high that coincided with their earnings report, and so I think a very technically significant level, and that's why I have it color-coded yellow. If that level goes, and if it goes with conviction, yes, there's plenty of support below, and we'll watch each additional level. We'll watch the moving averages. The 200-day moving averages are down here around that 201 level. So let me just say this now, that based on these divergences and the scope of the divergences, everything we're at, in the coming weeks to months, if you were to short Facebook, at this point in time, and that could change, but at this point in time, that would be my preferred swing target, about 201.86. and that just happens to be about a 15% drop as well, right in line with Apple. So there, right or wrong, maybe the Fed continues to power this market up. Maybe retail investors do. Maybe it's institutional buyers. Maybe earnings are great. But based on what I'm seeing in the charts, that's telling me that a lot of these FAANG stocks are poised for a drop of about, or I should say, at least 15%, and that would bring the market down about 15% as well. And so just to wrap it up, we have divergences, we have overbought conditions, a lot of things that go in there. We just need some sell signals. Fortunately, we don't have a very clean trend line, but I did give you some levels that should open the door to more selling if and when taken out. Also, keep in mind that if it's intraday, you want to see a solid move down below that area where it looks unlikely you're going to get a recovery, especially if you get a close down below those levels, because it's not uncommon to see brief intraday spikes down below only to see a stick save at the end of the day. The buyers come back in and rally a stock back above a support level. All right. Yeah, I was about to wrap up the video, and I realized I probably should loop back to QQQ and maybe SPY to give you guys some targets there if you are looking to, put on some shorts into or around earnings. Now, the benefit of QQQ is diversification. If you go with Apple, Facebook, any of those that go into earnings, and the stock happens to gap up or down 5, maybe even 10% or more, as big as those companies are, they're the largest in the world, they are prone. I have seen gaps, into the, double digits on some of those at times. It's not that common, but it does happen. So, if you have an individual position, long or short, and you have a 10%, 8 to 10% gap against you, it might hurt you, and it'll probably bypass your stop. Whereas when you go with the index, you buy QQQ, you're effectively buying a basket of 100 stocks. So if any one of those stocks has a big move, earnings-induced gap, it's less likely to, it's not going to impact you as much because you're going to have other stocks that'll kind of offset that. So targets, I'm looking at, of course, sell signals I already covered. You need to take out the blue trend line in this level here. But my swing target, just tell you right now, preferred swing target is right here, 228.68. We'll call that 229. That's about a 14% drop. And again, that would coincide roughly with those drops in a lot of those FAANG stocks, that 15% or so drop. So there's your target range, maybe down there to 224.45. That's right at the 15% mark. So we'll call this my target zone right here in the coming weeks to months. And I like to do these videos in advance because one thing that we know, we saw it here, we saw it here. When the tide changes, when the momentum and the trend changes, things can move very fast. So I want to get these levels out in advance so you guys can study the charts, decide what you want to do. If you're bullish and long, you might the takeaway might be, okay, well, Randy, you've been talking about the correction for a while, the potential for correction, but we keep going up. Fine, continue to trail your stops up. I'm giving you levels that are likely to trigger more downside, and so you could have stops just below those levels. If you're super bullish, you can step in and buy pullbacks to those levels. And again, if you're bearish, you can add to your short or initiate or add to short positions on breaks below any or all of those levels, and then look to swing down there. And if we start to approach this level, this target zone about 224 to 229 or so, if and as we start to approach there, we'll look at the charts, see how they look at the time, and then try to determine if it's a good time to cover shorts and maybe even reverse into long positions or sit tight. And a lot of that will have to do with what's going on the weekly charts, the daily charts, 60-minute charts, everything else. And I'd be remiss not to cover the SPY. A lot of people prefer to trade the S&P 500. Just like leading up to the February highs, we have negative divergence. First time we've had it on the daily chart since then. There are even larger divergences now. The SPY, like just every other index really besides QQQ, is still well off its highs. So it's one could sit and argue, debate whether this is still just a bear market rally or the start of something more. And I can tell you, here's a trend line off the lows right there, the March lows. Fairly well defined with a lot of reactions recently. There's your divergence right there. Levels to watch and targets would be, I'd say right here about 295. Remember that we had this multi-month trading range at that point. It was about a month-long trading range right here, and that would give you about not as much as the Qs, because what happens is the Qs, there's a little bubble going on in technology right now, momentum trade, and I would suspect you're going to get a lot more bang for your buck shorting the Qs if and when the tide finally, or more so when the tide finally turns, not if it turns, when it turns, and so therefore that target is only about 10% in SPY right now, and that's a rough target. If we go to the bottom of the trading range, it's possible that would be a 15% drop. So if we see things like the financials and some other sectors really start moving down, I think we'll just see most of the money flowing out of tech when a lot of those momentum traders booking profits, stops being hit, shorts piling in. So I just wanted to give you, as of now, like I'm saying, ballpark target about 295 right there, about a 10% downside or so in the S&P 500. And if and when we start to get anywhere close to that level, if it starts to pan out, keep in mind that's going to have taken us just below all the big moving averages. You don't see them on here. I'll turn them up a little bit so you can see the colors. The 200-day simple and exponential. Here's the exponential. The simple's just above it. So that would also take us back down for a test of those moving averages. Maybe undercut them briefly if we hit that 295, and a lot of buyers will step in there. And if we have, remember, stocks tend to fall faster than they rise. So if we get that correction, I would put good money that we're going to at least make a temporary overshoot of those moving averages, and probably then reverse and have at least some buyers step in there. I would be surprised, very surprised, to see the market, if things got ugly, just go right through the 200 days, right through that support as if it wasn't even there. So that's why I'm talking, this target, an objective level to swing down if you're looking for shorts and you're looking somewhere to play a bounce trade. All right, let's wrap it up here. Let me get the video out to you guys, and we'll sit tight, see what Microsoft does tonight, and then and again, that's only the first of the 5 to report. So over the next couple of weeks, we'll start to get an idea of whether this market wants to build on these gains or if the run is over for the time being. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.